that, let's bring in Thomas Hayes, Chairman and Managing Member of Great Hill Capital. Thomas, welcome back.
Thanks for having me, Anne, and good to speak with you, Corey, as well.
Hi, Tom.
Hi.
Wow, we are going to get these questions out there, Thomas. We've got a lot to get through and a lot about inflation right now. Let's start with this producer price index data, Tom. July inflation higher than expected this morning, but only a tiny bit. We're talking about 0.3% versus 0.2%, and yet the markets, at least the futures, are already in the red. What do you make of this?
Well, the good news is the Fed doesn't have to worry about deflation. If you looked at the PPI numbers last month, it became a little worrisome with 0.1% was the print. And you started to worry about what's happening in the economy. Are things slowing more than everyone expects? So this month kind of confirmed that while it's pretty much flatlining, if you look over the last year, just look at the table. I mean, even at 0.3, it's collapsed. It's showing that probably getting to 2% target is going to take a little longer than anticipated. The market's now a little concerned. Okay, do we get a hike in September? As of yesterday, after the CPI print, the Fed Fund futures were showing like a 9.2 or 9.5% probability of a hike in September. My guess is maybe that bumps up to 13 or 15% today. But I think the key with all of this, Anne, is if you think about it in the context of a global economy, the Fed is going to finish first, okay? Whether they do another hike or they don't do another hike, they're going to finish tightening first. And I think that bodes well for two trends into the second half of the year. The first being the dollar softness that began in October should persist, meaning the dollar will stay soft and maybe even a little bit softer than we've seen, despite the short-term counter trend bounces. And I think the second thing that we're going to see, which will surprise a lot of people because it's not consensus in terms of if you look at positioning, is that after this $1 trillion of supply gets out there to refinance the government coffers, I think you're going to see a bid in bonds in the second half of the year, particularly the longer end of the curve. And that's certainly non-consensus, but as the Fed gets out of the way, that would be something in the cards.
And what are the implications of that, Tom,
Yeah.
of that yield trend
Yeah.
for the equity markets?
Yeah,
as our communities thinking about where to put their money?
Yeah, I think you nail it in terms of what does it mean. I think there are a few areas that have been unloved, so to speak. We know what led the first 5 months of the year was the Magnificent Seven. Then you saw some broadening of the rally in June and July. That was very constructive for the market. But if we do get a bid in the long end of the curve, that's going to help interest rate sensitive stocks, particularly REITs. REITs have started to sniff this out. They've been left for dead. They've been one of the most hated sectors. Second thing would be banks. And it's kind of counterintuitive because you think about, I need a steep yield curve for banks to work. But the overhang on the banks and the downgrade is largely driven by banks were flooded with deposits during COVID as the Fed kept rates low. And they were forced to put that money to work. And you would think it's relatively low duration, 5.7 years, but they flooded into treasuries towards the short end of the curve. And those securities, after 550 basis points of hikes, more or less, have been underwater. So if treasuries start to get bid, that's going to be a dramatic help for banks because their balance sheets mark-to-markets will improve and look a lot more healthy, and Moody's will have to retract their downgrade, and which helps ultimately small caps, which is 21% financials.
So you're seeing a rally in small mid caps starting when, Tom? You're predicting next year?
It started in June. So it started in June. I think we're going to see that persisting through the end of the year in fits and starts. I think REITs, banks, and small caps are going to be the beneficiaries of the bid in treasuries. And I think as far as the soft dollar, multinationals that get 40-50% plus of their revenues abroad, companies like PayPal, I think we share an affinity for that one, deep value grab there. Emerging markets, I think, is going to outperform relative to developed markets on the basis of a dollar staying soft. And I think you could see some risk on in a left for dead group that no one wants to touch with the 10-foot pole, namely biotech. And biotech tends to take off when the Fed gets out of the way. And whether they're out of the way by by September, or if it's the following meeting, we can't predict that. But they're going to be out of the way sooner than other central banks around the world.
Tom, that's a really comprehensive breakdown of the different sectors. So lots to follow up there and lots to track.
Yeah.
Let's go from broad sectors to some specific names. Let's talk about Amazon. Corey, as we heard her describe, seen Amazon paring back on, for example, its in-house brands in clothing, somewhat in furniture, trying to reduce packaging in its logistics process, a push to try to get some efficiency through its system. How do you see Amazon performing right now? If you look at it versus some of the rest of the Magnificent Seven, to your point, how do you feel about this one?
Yeah, it's interesting. So we've developed a reputation of really profiting from periods of dislocation. So we were buying tech and semiconductors in fall of last year. And the two of the Magnificent Seven that we bought last fall were Amazon and Alphabet. And we continue to hold them. And to your point, they have had a very large run. And you say, okay, what's the next leg? Is this going to start to consolidate as we get a broadening of the market? And I think the answer is yes, but I want to own these for, a longer term play, given the low prices we were able to acquire them last year. In terms of Amazon, we saw the quarterly reports, revenues up 11%, AWS up 12%. The demand for compute power and generative AI is virtually unlimited, and that's going to be the pure play in the US. There's a pure play in China, which we have a big position in. We can talk about that if you care to, but their initiatives across the board have been creating efficiency, cost cutting, because if you remember, they overexpanded during COVID with warehouse costs, with labor costs, and they've been paring that back. Now, I guess packaging costs on top of that, cutting down some of their lines to avoid the antitrust, as you alluded to. But I wouldn't be surprised. We're not going to do anything. We're going to hold it. But I wouldn't be surprised if all the Magnificent Seven, you've seen Apple, you've seen Microsoft, but even Amazon and Alphabet, consolidated a little bit. Everyone knows we're in a period of seasonal weakness. But I think for those people waiting for the 8 to 10% seasonal pullback or correction in the fall, they may be disappointed and they may be waiting for a long time because institutions were just too underweight and they missed the first half. So they're going to have to buy the dips. And I think you're going to see an institutional bid on any 3 to 5% seasonal pullbacks.
Tom Hayes, Chairman and Managing Member of Great Hill Capital. Thank you for joining us this morning. That'll do it, folks.